amazing panel. Jeff Clavier, SoftTech VC MP, Jose Marin, Managing Partner at FG Labs, Brian Caulfield, Partner at Draper, Sean Seaton Rogers, Founding Partners of Pro Founders Capital, and John Bradford, Founding Partner of Motive Partners. The stage is yours, Jeff. Enjoy.
A clap for the band. Hey. So back at home, we called that a founder welcome, and I just told these guys, hey, it would be nice to walk on stage and have the standing ovation, which means that even if we suck, we still got it. So thank you so much for making our day as speakers. We really appreciate that. So we're going to be together for the next half hour. We're going to talk about investing. Very, very privileged to have awesome investors sort of joining me, and we'll try and talk about a bunch of different things, which will obviously be, I guess, interesting and relevant for you guys as potential founders, entrepreneurs, co-investors. So to get us started, name, firm, stage, geography, and key sectors in 30 seconds. Jose.
Sure. Well, we basically focus on things we understand very well, marketplaces. Most of what we do is in the US. 75% of our transactions are in the US, but we are still global investors. We also are stage agnostic, so we write checks from the beginning to all the way pre-IPO. And our strategy is not to lead. Generally, we co-invest with other people just to make sure that we don't step on the feet of some of the very large and interesting players, and just be a complement to the round rather than joining the board and stuff like that. We don't join boards as well.
And you're Jose from FG Labs.
Jose Marin from FG Labs.
DJs. Brian.
So Brian Caulfield from Draper Esprit. We're a pan-European venture capital investor based primarily in London. We invest about 30% of our capital at Series A, 70% Series B, C, and beyond. Sectorally, we're pretty broad. We cover everything from enterprise software through consumer internet to hardware, which makes us a little bit unusual. We still do hardware deals. And we're also hot on digital health right now as well.
Awesome.
Hi, everyone.
Sean.
My name is Sean. I'm with Pro Founders Capital, based in London. We invest into pan-European, and we define that as Eurovision Song Contest countries, which is the broadest definition of Europe that there is. So we invest in companies raising between 1 to 3 million euros. So first round of capital, we'll cut a check for half that amount. And we also love to invest into businesses that use technology to improve what are crappy, painful customer experiences. If you can make annoying, painful things better, easier, cheaper, faster, that's what we like.
Awesome. John?
John Bradford, partner at Motive. Motive is a growth fund for financial technology, but we do B2B, not B2C. Check size $10 million and above, and we have offices in London and New York.
Awesome. So what I like to do in those kinds of diverse panels is to talk about hard or not. So tomorrow, actually, I will give a presentation, and then we'll have just a screen that says, this is what's hot in Silicon Valley, that's what's not hot. So I'd like to get your own version of the hard or not, the couple of sectors or types of marketplaces or types of businesses you're super excited about and are very much looking forward to funding right now, and what has sort of fallen out of favor for you guys, because it's kind of important for entrepreneurs to know that something they have in mind might actually not be that interesting to investors. Jose.
Sure. I mean, what I can say is within the marketplace space, we've seen a very interesting evolution from horizontal listing marketplaces to horizontal transactional to vertical transactional. And we initially felt that there were only certain categories where you could disrupt the horizontals, where you really required a very particular user experience or a very particular product. But we've been very positively surprised to see that there's been disruption in other verticals that are not necessarily only those that that require a very specific experience. And that's one of the theses that we're following right now. So we are attacking some of those verticals that we believe have enough size, enough scale. I can give an example. It's a company called Reverb. It's a marketplace for musical instruments. I mean, you would imagine that eBay or others have that pretty much covered, and these guys are, a run rate. They're doing about 20 million bucks in GMV per month. So it's
And that's selling, not renting.
Yes, that's selling. And what I can say is it's been very surprising to see that that a lot of these verticals are probably way bigger than what we thought. And even though that there's not that much differentiation on the strategy of the vertical, there's been a number of players that have picked up. The second thing I would say is we also see a migration. We are very economics driven, so we focus very much on unit economics, and we like to see businesses that have, on a rule of thumb, generate 3 times the cost of acquisition of different channels per channel on a period of 18 months. So we think that way, and frankly, what we've been seeing in marketplaces is that there's an evolution towards the B2B, and you have two type of things. You have high average ticket value, potentially with less, repetition, or you have maybe lower value of transaction with higher repetition. So you need to have both to make sure that that the unit economics work. Obviously, the margin is important, and as we move into the B2B, we've seen better margins and some of these dynamics come up. So we are also pretty bullish on a number of B2Bs. We invested in a company called Flexport that basically
Good for you.
exemplifies that. We think it's a very challenging business, but clearly it shows that the unit economics and margins of B2B can be attractive. And lastly, we're also looking. We don't think that we should be investing on things that we don't understand really, really well. So things like artificial intelligence and stuff like that. We would not invest on the incumbents, but we would definitely invest on marketplaces that are enabled. And we've seen a number of marketplaces that are utilizing artificial intelligence for both the supply and demand and making the unit economics more attractive. And that's also something that we're looking with very positive eyes.
Cool. And if there are marketplace entrepreneurs here, I can tell you, Fabrice, Jose's partner, and Jose are really sort of awesome investors. So you want to try and get them in your company.
Thank you.
Brian.
So I kind of jumped the gun a little bit by already mentioning digital health, but that's an area we're very hot on right now. We think that digital health, relative to the scale of the market opportunity, is actually still massively underinvested relative to the amount of hype around the sector. Generally speaking, in digital health, we're looking for opportunities that don't involve selling direct to the public health system. Mm-hmm. We want to ideally go around the public health system and either go direct to consumer or B2B, so we're kind of avoiding highly regulated markets. The other sector I think is really interesting.
A couple of examples of companies that you'd like to mention, just to give us a sense of what...
So yeah, to give you an example, we're a major investor in a company called Clue, which is a women's health app. It doesn't monetize actively today, but it's got 9 million incredibly engaged users, generating some incredibly interesting data. Another example in the UK would be Push Doctor, which is kind of doctor on demand, video doctor on demand with prescription services and so on. And people said, how can you do that in a country that has free GP care? And the answer is simple. Nobody wants to take a day off work to go to their GP, and they need access to doctors when their kids are sick at 11 at night and so on. So that's going extremely well. So those are the types of opportunities. We also think hardware is back. AI and IoT in particular are fundamentally changing compute workloads, and when you change the compute workload, you create opportunities for new architectures, and new architectures are what drive big opportunities in the hardware space. If all you're doing is a kind of a slightly better version of what Intel do today, then that's not very useful. But if you're radically changing the compute architecture, then we think that's extremely interesting. And then finally, AI is going to have an enormous impact across a wide range of industries. I think I hate to hear a company come and say to us, we're an AI company. Tell me what problem you solve in which industry, and how the AI technology that you utilize enables you to disrupt that industry. Don't kind of come and expect that because you say we're an AI company, you're going to kind of raise $10 million with no traction.
In the Valley, they will. They absolutely will. But it's us. So, do you find that downstream investments for hardware companies are easy to come by or hard to come by? Because what I've noticed in the Valley, and I'm one of the essentially heaviest portfolio in terms of hardware, connected hardware, after seeding Fitbit 9 years ago, it's just become harder to find co-investors for hardware, Series B, Series C rounds. What have you guys seen here?
It is tough. I mean, I think hardware remains unfashionable, and a lot of investors have kind of pretty much walked away from hardware. And to give you an example, we recently had a great exit with a company called Movidius, which was acquired by Intel, and we did a VC panel at the Global Semiconductor Alliance's entrepreneurship conference, and the entire panel was investors in Movidius because there kind of wasn't anybody else, So what it means is that you've got to build strong syndicates early, and you have to be prepared to bring strategic investors into the mix, and that's what we typically do,
Awesome. Sean.
Great. I'm going to give you guys a little bit of a history lesson in 30 seconds, if that's okay. Now, we believe there are certain sectors where historically Europe created the global leaders in those sectors. So if you think about the music space, for a long time, back Beatles, the Rolling Stones, Mozart, Beethoven, music was centered in Europe. Same as travel. 7 of the world's top 10 travel destinations are Europe. Same as fintech. London, Switzerland led the creation of the global banking system. What happened was in the 60s, 70s through the early 2000s, the US took the lead, and especially in the startup world. And the US especially has been great at creating platform plays. And most of the infrastructure, we believe, has now been built out. So what it comes back to now is what are the design, creative-led services that you build on top of the platforms that are already there. And we think having deep knowledge, expertise in those verticals makes a difference now. And so that's why we look at it and we say, the global leading music companies are coming out of Europe now. Spotify, Shazam, Songkick, SoundCloud, Deezer, they're bigger than any US companies. The world's biggest travel company, Booking.com, is based out of Europe. The same as if you look at fashion, where London, Paris, Milan were global leaders. Yoox now, ASOS, all the early leading fashion companies are coming out of Europe. So we think it's back to the strengths, basically. So we're big fans of education initiatives. Education came out of Europe for the most part, current education system. So fashion, travel, those kinds of businesses.
Awesome. And things you don't like? Because no one has addressed the things that you no longer sort of look at.
What was that about hardware? Hard to find co-investors, right?
So Sean, no hardware for you?
We have one foray into hardware, and it's been a mixed result to date. But actually, you mentioned no co-investors, but maybe this is my naivete, but isn't a lot of the co-investors coming from the public world now, where Kickstarter and programs like that are actually funding the initial development of a lot of these hardware businesses?
I think that's true if you're talking about consumer hardware. Yeah. If you're talking about, my favorite personal portfolio company right now is a Bristol-based startup called GraphCore, which is building an NVIDIA killer, essentially.
Yes, not quite Kickstarter.
You're not going to do that on Kickstarter.
Yeah.
It hasn't taped out a product and has raised $62 million already, so... but for things like consumer stuff,
yes.
For sure.
Yeah.
But we don't like those businesses because somebody will just tear that product down real quick, and they're going to make it in China for sixpence.
John.
Unfortunately, everything in fintech's hot at the minute, and there's not much that's not, which is another way of describing everything's just very overvalued or expensive. The way we
VCs always complain about the price and everything being expensive. Just saying.
Fintech, we kind of see as this kind of was the initial first wave. A lot of it was B2C. I think it's caught a lot of the entrepreneurs and the investors slightly off balance because of regulation and compliance. Even though everybody talked about it, means that things have taken much longer. The amount of capital required to get them to some sort of critical mass is a lot more than anybody expected. Interestingly, actually some of the most interesting players in Europe are actually being backed by big US businesses. So N26 is Peter Thiel. You could argue that Revolut is Index, which is heavily now towards the US market. And so there's kind of that initial shift that came out, and I think there's a lot of people looking at a lot of those B2C businesses, trying to figure out whether they're going anywhere, that they're not. I know of a number of those B2C businesses which are actually now shifting towards a B2B2C model, where they're using the legacy incumbents as essentially as distribution platforms, or potentially looking at, what's interesting is they're actually playing partnership models rather than white label models, because actually the legacy companies can see the inherent value of the brand value of actually being associated with some young whippersnapper of a startup. On the B2B side that we predominantly look at is dull and is very uninteresting, but it's true, which is it's all about compliance. I mean, the pointy end of the stick, which has got all of the big financial institutions excited or taking steps to actually go and buy technology relatively quickly, is the compliance part.
That's a good point. Sorry, we actually can't see hands, but how many people know what GDPR stands for and is? And I actually can't see anything.
Yeah,
I mean, there's no hands out there.
It's really
Every
horrible.
single company here, I don't care which startup you are, you need to Google GDPR and understand what it means for your company going forward. This whole cookie consent thing is going away. You have to tell your customer exactly what you're doing with the data, how you're going to use it. They have the right to delete it at any point. And it's a massive opportunity for companies to move into.
Yeah, and we had a session in the office back home in San Francisco about the impact of GDPR for kind of consumer companies. And people literally had no clue. And we said, hang on, like if you have a user in Germany or in the UK, like it doesn't matter your US website, you're in trouble. Yeah. So there is a lot of education to be done on that.
Yeah, it's horrible. And it genuinely coming back to the point, it impacts absolutely everything that's going on. I think of it as just it's the European Union's way of trying to slow down Facebook and Google at this point in time.
And by the way, from a consumer perspective, it's actually not the worst thing, because I think when you actually start seeing how companies are using your data, you're going to be quite scared. They always say, you know, if you're not paying for it, you are the product. Yeah. You're finally going to realize that you are the product.
I think the challenge, though, is that the overhead that it imposes, especially on small, early-stage companies, relative to the benefit for the consumer, because there absolutely are benefits to the consumer, is disproportionate. Yep. You know, it really is. I think it's kind of quite scary for early stage companies.
Sounds like a great SaaS product that you can just plug in that will solve GDPR. Someone create that.
We saw a couple of those.
I think, Jeff, it would be interesting that you answer the same question. I mean, you run a very interesting investment group in the Valley, so where do you see the opportunities?
Well, I'm glad you asked that. You just have to be here tomorrow at 9:25. The Hudson. So we are a bit like Brian, very, very broad. So SaaS, B2B enterprise, marketplaces with you guys, a little bit of monetized consumer, and then where I do most of my investing, connected hardware, both B2B and B2C. And frontier tech, and my talk tomorrow is about frontier tech and what it means to invest in frontier tech. What we don't do is essentially everything Sean does. I'm not surprised that we don't actually invest recently. We haven't invested recently, so we don't do fashion. We don't do e-commerce in general, but we don't do travel. We don't do e-commerce. We don't do music. Literally, we run away the other, because there's always like a couple of bad, sort of apples in the portfolio that lead you to run away from a given sector, and yeah, that's pretty much what we've passed on. But we explore a lot of things in AI, AR, VR. I just closed a space tech investment. Did like an NVIDIA killer, but it sounds like you're on the graphics side. I'm on the computation side, so we should partner and kill them.
Yeah, we should talk.
Absolutely. So there's literally no end to what we may do once we're comfortable with a given category, and I'll try and explain why tomorrow. But thanks for the probe. So the panel was about the secret weapon. What I'd like to turn that into is how do you guys sort of do your initial filtering? Is it market opportunity? Is it differentiated product? Is it sort of team first? How do you guys sort of go about this initial filter that will make you decide whether you're going to go deep on an opportunity or not? Anyone?
I mean, in our case, I have to say that we are investors, but we continue to be entrepreneurs, and both my partner and I have built several businesses before. So I think that we are probably more entrepreneurs turned investors than real blooded investors. So I think that plays a role. We care very much. Little by little, we started investing without really having a very systematized approach to it. Then the results started to be much better than what we ever expected, and then we started to put a lot of discipline and structure into this. And we like to invest in companies that follow our heuristics. We have a number of heuristics. I can mention some, but you can also see that in my business partner's blog.
Yep, they have an awesome playbook for.
So we have a very well-structured line of thought, to what are some of the things that we like to see in businesses. But what I can say is, the most important thing for us is a team, because we've seen fantastic ideas with teams that we like so, and we would never do a deal like that. But we've done incredible teams with ideas that were so, and we would definitely do that. So, we get about 100 deals per week, and we obviously don't know and understand everything, and a lot of those deals are on things that we have no idea. So out of those 100, about 50 end up being in our, let's say, line of business, and then we follow a process where each one of our analysts have a first call with them, do a first round evaluation, write a very systematic review on that, share it with the whole team, and then we have a call on a weekly basis where we screen through those, and whenever we need to do additional research, we do it.
And at the end, because we're running out of time, at the end, how many deals do you do per month or per year?
We are doing about 2 deals per year, per month, sorry. I mean, sometimes several of those can be follow-ons. Mm-hmm. Last year we did 61 transactions, out of which 51 were, so that's almost a deal per week.
Mm-hmm. Okay.
So we're typically not the first capital into a company. So usually a company will have raised at least seed, maybe Series A before we invest. So we're very focused on building relationships with the high quality seed and Series A investors in the market, and not just talking to them once, but talking to them on an ongoing basis and building the relationship. So when one of their kind of quality companies is coming to the market, we're there. We also do a fair amount of kind of thematic searching. For example, we might say, okay, we think insurance technology is, insurance as an industry is underpenetrated, let's go after that. We don't expect to be the ones who have the real market insight. That's the job of the entrepreneurs, and we want to find the entrepreneurs who have that kind of, if you like, that special market insight. So that's really broadly our approach.
Cool.
So our decision-making process is actually quite simple, and I would say it's built on the fact that we're probably the earliest stage fund, kind of sitting at this table. But we know every company we invest into will need to raise more money. So we think about 2 things. Number 1 is how the team's going to present at the next round. So that comes down to the quality of the team, the way they can pitch the vision, and then we also think about what can they prove over the next 12 to 18 months that allows them to be able to raise that next round of financing. So I don't say we're milestones driven, but we work very closely with the team to understand what are the key objectives for this round of financing, and what can we do together to prove out just one thing, because you can't prove more than one thing with every round of financing. What is the one thing they need to prove, and how can we help them prove it?
Awesome. As a later stage fund, clearly most entrepreneurs look at us as just bigger bags of money. I will not pretend otherwise.
We like you for more than your money, John. Come on.
The reality is, the reason why the fund has been set up is the way we look at things are, can we make a material difference to actually being able to help those businesses grow faster? The founders of the business have effectively been selling technology into the industry, or buyers of that technology, for 20 years, and they know everybody up and down Wall Street and all the big financial institutions. So it is, can we make a material difference to when we add money to the pot?
Very cool. Well, we're very similar to Sean. So we think about, that trio, founder, so exceptional founders having a unique insight on a given, opportunity, sort of a very differentiated product, because if it's just, as you said, 10% better, then there's no point. And then the market opportunity, the way we sort of define it for a lot of our B2B companies is what is the path to $100 million in revenue in, 5 years or faster, and if it's faster, it's awesome. And that sort of gets us a sense of the hurdles we need to clear. And like Sean, we think about fundability a lot. And because of the breadth of investments we make, SaaS is pretty boring. Get to 1.5 to $2 million in ARR and have, an ACV over CAC of X and show, certain growth and so on and so forth. Pretty clear. When we go into market creation, some of our frontier tech companies, there's literally no market when we invest. And trying to prove those is always sort of very tricky. Thank God, in the Valley, we have a lot of investors who will follow us in those sort of crazy bets. The problem is that the hurdles have to be cleared at some point. And so if you raise a Series A with 100K in revenue as opposed to 2 million, you're going to have to make that 2 million at some point. So it always sort of catches up with you. So it's a bit tricky. One or two semi-provocative sort of questions to wrap us up. So there's a lot of talks these days that we're all going to be out of a job because of ICOs, initial coin offerings, because you can raise a bunch of money selling tokens to the public. So we're not needed. So gents, prepare your conversion. Like, how do you feel about this? Are you investing in tokens? Are you like me thinking this is bullshit? The same way Angels didn't put us out of a job. It's a very complementary product. ICOs will be used once they're regulated, because right now it's a fucking Far West. And people are going to go to jail because they've made a lot of people very, very poor. Like, wait for the Bernie Madoff of ICOs. I said it first. So anyone has a different view?
So you're 100% right. It is going to be regulated, because basically it is, I don't want to say scams, but it's a lot of companies. I always wonder who the buyers are, because it's kind of crazy. Companies raising hundreds of million with nothing. On the other hand, I'm sure that our forefathers in the venture industry in 1996 were saying the exact same stuff about the internet revolution and saying this is ridiculous, money's just pouring in, it's nuts, people are going to go to jail. And there were some scammers out there. But I think for all of us, we have to pay special attention to what it means and how our companies can actually use this when it is regulated to their advantage.
I think once it becomes a tool like others they can have in the arsenal, it's actually going to be really interesting to democratize access and investment together. I think that's fascinating.
Yeah, I think the reality is there'll always be a place for managers of some kind. VCs should not be merely a gatekeeper to money. They should be adding value. And I guess the question is, if you've done an ICO and you've got 1 million tiny shareholders, who do you talk to when you want to do an acquisition, and you need somebody around the table who's been involved in 20 M&A transactions or 50 M&A transactions, and you need that input and advice. You're not going to get that from your ICO shareholders, but it's a valuable tool. And our take would be you need to invest in and participate in the disruption of your own industry. So, for example, we're investors in both Seedrs and Crowdcube because we think that crowdfunding, equity crowdfunding, is going to be an important part of the mix, and the democratization of access to the asset class is fundamentally a good thing.
Cool.
I think that, my personal view is that blockchain technology is absolutely transformational, and I think it's here to stay. What I think we have to be careful with is, what companies use the blockchain technology for, and then whether there is a real need for cryptocurrencies, in an ICO. So I think that that's the fundamental, and so long as we have a good explanation for that, it's going to be valuable. Now, I also think that there is a lot of questioning around the VC model, and whether, having huge funds, people are raising more and more capital, having huge funds where people really don't necessarily have to have big success to make money. I think there's questions around the sustainability of that model moving forward.
John, as a fintech investor?
Dead easy. I think the underlying technology of ICOs is really, really interesting. I think the idea of throwing money in a pot is you might as well stand in the back garden and burn euros or dollars or pounds. I think if you turn the ICO tool set and actually allow users or participants in networks to earn them, like for a network effect type business. So if you imagine Facebook halfway through its journey said anybody who's a user and based on their interaction can earn as part of an ICO, and actually then it suddenly becomes a self-fulfilling prophecy. I think one can share the benefit of the economics far beyond the stakeholders or the shareholders, but also into other stakeholders.
Yeah, the browser called Brave is trying to do that.
Yeah.
And just think about it, right? In the world of ICO, who actually sits on VC panels, right? Anyway, that will be our parting thought. Thank you so much for being with us. We enjoyed our talk. Join me in thanking the panel and enjoy the rest of the conference.